Q4 was a strong one for global equities, as we saw a broad market rally and risk-on trade straight into the last day of the year. The defensive characteristics of infrastructure lagged in an upmarket and witnessed only about half of the upmarket return in the quarter. Healthcare and technology led the way higher in the broad market, and these are two areas not included in infrastructure. Our fund, while posting a positive return in the quarter, did mildly lag infrastructure, and I'd say that was due mostly to the value we maintain in the fund. We will typically lag the market on the upside and protect well on the downside. There are a few areas where we've moved around our positioning in the fund. The fund and the ETF are today, as they are always, positioned exactly the same. And as far as how we are positioned today, well, the UK was a sizable overweight for us for some time over the last 2 years. As we made our way through the end of this year, and culminating with the Conservatives' general election victory in December, we witnessed positive performance in these assets, and used this performance as an opportunity to take some profits and pull down our weight there. We are still overweight the UK selectively, and think that there is still some value to be had there, but have pulled down our sizable overweight in recognition of some of the moves we saw through the end of the year. The fund is starting the year back up to our maximum weighting in utilities. This is probably only the second time in the 8+ years we've been managing the strategy where we own this many utilities in the fund. And most of that overweight is coming out of Europe. With the push towards renewables accelerating in most of Southern Europe, we still believe the growth we will see out of this space continues to be massively underappreciated by the market, and we are focusing a lot of our weight where we see value here. Importantly, this growth isn't coming at the expense of yield, as we are still able to see quite a bit of equity income coming from this sector as well, as much as we've ever seen in fact. And our ability to continue to generate a 6% level of yield is as strong as it's ever been coming into this year. If the market continues to remain concerned around some of the recent conflict between the US and Iran, or the US and China, it's important to remember that infrastructure is mostly a domestic business wherever it's located, and this should insulate these businesses from these types of conflicts. With the value we are finding today across the European utility space, as well as the North American energy infrastructure space, in the US and selectively in Canada, we believe we can continue to maintain the balance in the fund we always strive to maintain, while also continuing to generate a 6% level of yield. Thank you for your time.